Welcome back to the show. Today we're going to dig deeper into some investment strategies. Today we have Joseph. I know some of you are familiar with him.
Okay, and following your comment, Yusuf, about like, okay, choose the company who will pay dividends and get loans for this, where I can find this gold list of wonderful companies.
That's
ChatGPT can help, or maybe I have some source websites, friends, where I can get the info.
that's a wonderful question. So there is something called a dividend ETF, exchange traded fund. What used to be kind of thought of as mutual funds, now we do ETFs because they have lower expenses. Basically, like one is SCHD. So you can go on Yahoo Finance or any broker or whatever and search SCHD, and you can find out which companies this fund holds. They hold Verizon, which pays a telephone company, pays out dividend, and a number of other dividend paying companies. And that's one place to start that you can see SCHD is holding a basket of diversified companies across multiple industries that pay dividends. And that's a starting jumping off point. You see what is the Schwab dividend, and they have a SCHD is the domestic US, SCHY is the international. So you can do the same process for the international ones and see exactly what companies do they hold. And then you can go research individual companies. And that's a great place to get started. They have also I forgot the ticker, but it's called like the Dividend Aristocrats. You can just Google that. There's a number of companies that are designated aristocrats, and that's the kind of company I was talking about earlier that might be inclined to borrow money to pay the dividend. They want to keep their aristocrat status, right?
So now that we've got like how we're going to find these great dividend paying out stocks, and I know you kind of mentioned, I think you said drips. So first question is, what in your opinion is a great payout? And then what do you do when they're paying this out? You talk about this other strategy, which is a drip, and maybe you can tell us a little bit about what that strategy is and how that's like powerful
Yeah,
wealth building
drip.
strategy.
Yeah, great question. So DRIP is dividend reinvestment plan. So you can either do that through your broker or direct with the company that you're holding shares from. What it does is it automatically reinvests the dividends that you receive. So when you own like, okay, McDonald's, if you own 100 shares of McDonald's, every 3 months, and this is typical every quarter, the company will send you a check. You can take that and go cash it and go spend it, or you can automate reinvestment back into the company. So you can tell McDonald's directly, or you can tell your broker through which you hold McDonald's, hey, those dividends every 3 months, I don't want to be bothered to mess around with it. Just take that dividend it pays me and automatically buy more shares of McDonald's at the market price, whatever it happens to be that day, because I want to keep reinvesting in this company so that it compounds over time. And I don't want to think about it. I want it on
Oh,
autopilot, which is
I
really great.
great. And question, could it be automated?
Yeah, yeah, 100% automated. Yeah.
It's some tool or what is it?
It's like you sign up through every broker has a different way they do it. You
Mm.
sign up for a dividend reinvestment and I think you can turn on different, like you can say reinvest this company, but this one I want the cash and I want to hold the cash and do something else with it. If you're doing it through the company directly, you have to do the paperwork with each company. So I would recommend doing it through a broker.
Hmm.
So my first question is great for the drip. What should I be looking for as a good payout and dividend? And then, what would be meaningful for me?
The first thing I look at is sustainability. So we mentioned payout ratio. Can they sustain it? Like I've gotten in the position where I bought a stock that had, don't chase the yield. I bought a stock, like a high yield dividend would be 8, 10% or more, right? A typical dividend would be like 2 to 5%. And of course, this depends on like the macro environment. Like now, when the price of shares goes up, the dividend yield percentage goes down, and when vice versa. So you have to factor that into, but generally, if you're like between 2 and 6% dividend yield, if the company can sustain it, that's like the normal range. If you're getting 8% yields and interest rates aren't super high, like ask yourself what company can pay out 10%, 12%. I mean, there's some companies with like 20% dividend. Like, you know, um, how sustainable is that? And, I got caught chasing yield, on the company Hanes. They make underwear and socks, and Michael Jordan famously, can I get my Hanes on you or whatever? And, this is a small cap company. That means they have a small market capitalization and they're very risky. And a few months after I bought the stock, largely because I saw it was an 8% dividend yielder, they cut the dividend because they wanted to refinance their debt, which is the right thing to do for the value of the company, but that caused the shares to value to plummet. And then plus I don't get a return on capital in the meantime. So I'm stuck holding that. So that can happen. Dividend cuts are real, especially in recessions. So you want a
So
sustainable yield that what you're really looking for is a company with a long history of raising the dividend slowly. Johnson and Johnson, for example, famously hasn't lowered their dividend in like 70 years or whatever it is.
so when I like as a layman, I'll go to Google Finance and then I'll see the dividend yield figure there. You're saying don't really rely on that. What's the other place I can look other than the per so the yield, the percentage is the actual payout versus the
Yep.
on top of their stock price. So obviously, if it's
Yep.
higher, that means their stock price. There's a relative,
Yes.
difference there. But so
Yes.
where else can I look to get a more accurate understanding of the dividend payout, not
Yep.
as a percentage of stock price?
Growth. You want to look at growth, the compound annual growth rate of the dividend. You want to look back through the history. Have they been raising their dividends steadily over time, or has it gone up, down, up, down? How consistent is the payout? Payout ratio we talked about, how sustainable is it? And also you want to look at overall, if the company goes out of business, they're not paying a dividend, right? So you
Of
want
course.
to, is this, some companies that don't pay a dividend end up paying one. Like I held Alibaba for some years and they didn't pay a dividend at first, and then they started paying out a dividend. So if profitable companies eventually pay out, I imagine one day Amazon will pay out a dividend even. This is blasphemy, right? But Berkshire
Hmm.
Hathaway famously pays no dividends.
Hmm.
Buffett just reinvests back into, but he holds dividend stocks. For example, Coca-Cola, I think he paid $1.3 billion for his share of Coca-Cola. And now today it pays $700 million per year, every
Wow.
year.
Clever
So
man.
in perpetuity. He owns, whatever, however many 10% or whatever of Coca-Cola. That's a $700 million payout.
You talk a lot about payout ratio.
Yeah.
Like there, like some terms seem to be more important than the other. What exactly are you talking about when you say payout ratio? Where am I looking? Why is that important?
Payout ratio is how much the dollar amount they pay in dividends divided by the net income. So how much of the net income did they pay out as a percentage? That's why I keep
Okay.
talking about it, because it tells you how sustainable if a company isn't earning but is paying, it can't sustain it. But if it's paying 30% of its earnings out and retaining 70%, then that's
Okay.
very sustainable. There's room to grow the dividend over
Yeah,
time.
like
I,
you're referencing people who borrow money, but they're
yeah,
paying a dividend. The payout ratio would kind of uncover whether
would be
there's,
high. Yeah,
yeah,
if you've got an
okay.
80, 90% ratio or over 100%, that's how can you grow the dividend, right?
Yeah, that's pretty important actually. Really good.
Yeah.
If you watch this video, please leave a comment. Maybe open questions will left and we can cover them in the next video.